Good morning, everyone, and welcome to our South African Chamber of Commerce event today, sponsored by Sanlam. Thank you for your valued sponsorship, Mark. Didier and Gal are not here with us, but thank you to Didier and Gal as well. We're here today at United Docks, a new venue that we're testing, and we're very happy to see that the setup is actually very, very comfortable and beautiful. So thank you to Nitin and the United Docks guys for that. Rita Mashlaba, thank you for joining us from the South African High Commission. We really appreciate your presence here with us. And guys, it's a great opportunity to get to meet Rita and Mashlaba, because if ever you're looking for your passport and you need things to move fast, that's the people to talk to. So don't phone me anymore. You know who to phone. So guys, we had a great last event, our gala night at Sufren. So that was our year-end party ahead of time. Some lovely faces. I recognize some of you guys attended and had a good time. Also happy that the BFS event was fantastic. We coming in as world champions. Go Bokke! Without further ado, to move on to today, we're here to talk about the macroeconomic trends for 2024. I'm going to welcome on stage the head of Sanlam Private Wealth International. He used to be the head of Sanlam Private Wealth Mauritius. He used to have time for me. We used to swim. We used to meet each other at least once a week. Now I can't get him on the phone. He's in Nairobi, Botswana, Gaborone. I don't know where he is these days. I've been trying to catch him all week long. My ex-good friend, who's now taking the world and helping Sanlam Private Wealth to expand. So Mark, welcome on stage, and thank you for your sponsorship today.
We have now partnered with the SA Chamber for the last 3 years, and I think it's a partnership that we value greatly as the Sanlam Group. As Bilal mentioned, my two colleagues, Gail Duchesne and Didier Bion, who look after the trust business and the insurance business, couldn't be here. I do see Dario here at the back, who's also part of the Sanlam family. He's with the reinsurance business. Hi Dario, nice to see you. So welcome here. It is indeed a pleasure for us to be here again in Mauritius. And Kim, where are you? There you go. Thank you very much for putting this venue together. It's a bit of a change, but certainly is one I think that's working well. So well done. Thanks very much for all the hard work. Yes, as Bilal mentioned, I look after the Sanlam Private Wealth International business. That's everything outside of South Africa, and it is my pleasure, as part of my role, is to meet outstanding people. And one of those has been Arthur. And Arthur and I travel a fair amount together, different places. I'd have to say, Arthur, Mauritius is probably one of the more pleasant places that we've been to over the last while. This is Arthur's first time in Mauritius, and certainly won't be the last. It's also become a bit of a tradition for Sanlam Private Wealth, or the Sanlam Group, to host the final session of the SA Chamber event for the year. This is the final one, isn't it? And last year we had a look back on the year that was, and looking forward to 2023. And again, to follow tradition, Arthur's now going to do a look back on what's happened and what is to come. I had a session with Arthur last week where we did currency commentary. If anyone wants to watch that, by the way, I do get questions. It's on our YouTube page, where Arthur gives his views on where various currencies are going. Hard currencies, euros, the euro, the sterling and dollar, of course. And then also some emerging market currencies. And then you can judge Arthur on how accurate he is, and how well he looked into that crystal ball. So no pressure there, Arthur. But just a little bit about Arthur. I arrive at work very early in the morning, because we work we're across various time zones. So I'm at work at probably about 6:15 in the morning. If you're in Cape Town, it's still pitch dark at 6:15 in the morning, particularly in winter. But the one constant is that there's a light that's always on in one of the research centers, and it's always Arthur bent over looking at new research and data. So I hope he can share that with us today. So Arthur is a valued colleague within the Sanlam Group. Arthur has a BEcon, Econ. He's got a B Econ Hons. That is from the University of Stellenbosch, cum laude. He did a Master of Science, Master of Science degree from the University of London. Arthur, if you wouldn't mind coming to the stage, but we look forward to you enlightening us on what your views are and what the economy is going to do. So welcome, Arthur.
Okay, so today I'm going to try something a little bit different. I hope it works. So one of the things I'm going to try and do is give you a little bit of insight as to how we think about economics and Sanlam Investment Group. So Mark talked about, we do outlooks and we give views on the future, but I go from the standpoint that I actually cannot predict the future. Okay, so what you try and do is try and identify the underlying structural themes and how they're likely to play out over time. That's probably far more important. And then also in terms of when we talk about asset prices at Sanlam as well, we take very long-term views, but based very much on long-term history and what history can teach us. So, okay, but let's look back a little bit at the last year. Well, there we go. Something's going wrong. Do I need to point it somewhere? It's the other one. Okay, I'm going wrong. Okay, so the last year, what has the last year or two taught us? It's something that we've known for a very long time, and it's been repeated. The Fed matters. And the Fed matters not necessarily directly on every economy, but it matters because it sets the tone of global financial conditions. And global financial conditions feed through into everything. Growth, commodity prices, and all of those things impact us, as we've seen on our continent. So the Fed has got a problem at the moment. Well, it's got two. The one is inflation, because it's not quite down where it wants it to be. And the other one is that it's dealing with a government with a fairly loose fiscal policy, with no real indication that that fiscal policy is going to correct itself anytime soon. I'll get back to this in a second, because at the end of the day, fiscal policy is very important for the inflation outlook. Right, so bounce in inflation, a lot of it due to the pandemic, we know that. Global supply chains disrupted, obviously that results in a supply side shock, upward pressure on prices. But it wasn't just that. In the background, what we have had for a number of years in developed economies is very loose fiscal and monetary policies. And at the end of the day, my argument is that that did support domestic demand against the backdrop of supply not coming on board particularly strongly, especially in services, and that kept upward pressure on prices. So we've done a lot of monetary policy tightening here. Left-hand chart, you've seen this chart before. Sharp increase in interest rates. Why is that important? Obviously because it's going to work through with a lag into the US economy, and that'll set the tone, obviously, also for global growth. Now, relative to the neutral rate, that's the sort of equilibrium rate, we're already well above that, which means we're well into tightening territory in these economies. And watch for that to come through with a lag. Debate about whether the US is going to recession or not, we get to in a second, but in my opinion, growth is going to slow. Other very important thing for asset prices is that, remember, we benchmark off the global risk-free interest rate, that's the US interest rate, and there's been a big change there. For years, we've had negative to low real interest rates. We've moved into a positive real interest rate environment. And remember, for a very long period of time, those negative to low real interest rates were very supportive of equity prices. So it's something to think about. Okay, I'm going to go through the next couple of slides fairly quickly, because what we're watching, obviously, is US inflation comes down, because the theme for next year that's developing is that the US cuts interest rates at some point next year, and obviously that starts to help ease global financial conditions, and that feeds through, obviously, into better outlooks for emerging markets around the globe and their markets. The thing is that the Fed is still struggling with a fairly tight labor market. Now, what this chart shows you is it simply shows you the vacancies per unemployed person and the change from where it was in just before the pandemic. And you can see the labor market got very loose, but now, if you look at the number of vacancies per unemployed person, very difficult to fill. So it means that you've got a labor market shortage still. Now, the labor market will soften with a lag to the cycle, but the Fed's models work around this. And why does it work around this? If you've got too few people to fill the jobs, what's going to happen? They're going to demand high wages. and the Fed's always worried that feeds through into more inflation. So they want to see this labor market soften. But at the same time, there's this background fiscal problem that I talk about. So what has happened here, this very simplistically is just plotting money in the US, broad money supply, relative to the federal budget deficit on a cumulative basis. Okay, so left-hand chart is money supply, dollar trillions, right-hand axis is federal budget deficit, cumulative in dollar trillions. And look what happened there during the pandemic. Look at that spike in money supply. What was happening? What was happening is that the US government was printing checks or writing checks and giving them to households. That's it. Here's your money. And look at the big impact that that had. The deficit, so you've got to read that the number going up is the cumulative deficit rising, jumped upwards, and with it money supply. So why am I worried about that? Well, history has taught me that when you have sharp jumps in money supply that are sustained and they're reflecting loose fiscal policy, that's very often where you get sustained strong inflation in the economy. It's been no surprise to me that it's taken them quite a battle to start cooling things down. They are managing to do it, but look what they had to do to money supply. Actually had to flatten it out. And you can start seeing, I think you're going to see this in the credit numbers in the US. You're seeing lending standards tighten. You're seeing also at the same time willingness to lend decline. Historically, that's not been a good signal for credit in the US. This thing is going to work through with a lag. Problem is, look at that budget deficit. Still creeping upwards, still high, no sign in the medium-term projections that it's going to be coming down. That makes it difficult for the Fed. Okay, so you'll have noticed that by now I'm arguing this US economy is going to slow down. Question is, how much does it slow down? So for us in emerging markets, what would we like? We would like Goldilocks, right? Inflation comes down a bit more, the Fed waits a bit, cuts interest rates, the US doesn't go into recession, still grows, means it's supportive of global growth, means it's supportive of global commodity prices. That would be exactly what we would like to see the outcome. Is that going to happen? Well, I don't really know. Okay, but what I do know is that you've got to be quite nimble and quick and quite wary in this environment. Reason being, look at that left-hand chart. It's a leading indicator of economic activity in the US. I don't know what happened with the axis at the bottom, I'm sorry. Something clearly went wrong in translation. But bottom line is that that chart goes back to the 1960s. And so what it says is that every time that leading indicator on a year-on-year basis has gone into negative territory, look what happens to the bars. The bars are the GDP numbers on the left-hand chart there, and the line is the leading indicator. Well, it says that you've actually got an economic problem, right? But this environment is unusual. This is not a normal cycle. It's a post-pandemic cycle. We wrote all those checks, remember, that I talked about. That was a lot of money. Look at that top right-hand chart there. Those checks that were written out drove up household savings from 10% of personal disposable income to over 25%. That's a lot of money that was sitting there. And what's been happening is that people have been spending that. And that's what's been keeping consumption going, it's what's kept the economy going, it's kept the labor market strong, it's kept the Fed working. But we are getting to the point where that's beginning to fade out, and I think over the next couple of quarters that impact is going to fade out. And then the economy is going to be vulnerable because you've got this interest rate cycle working in the background. So that makes me concerned about growth. But the positive side of it is, and this is where the soft landing scenario comes from, is that productivity's picked up quite nicely in the US. Yes, off a very negative low base, but what that could do is it could mean that you could still have employment growth, wage growth still running at the moment at about 4%. Hopefully it does soften a little bit, but that if you have productivity growth that's consistent with lower inflation, so over time inflation can get towards where the Fed would want it, and that it can then cut interest rates while the economy is still growing somewhat. Right, so we'll have to wait and see what the outcome is. The bottom line for me is I think relative to expectations, growth probably surprises a bit on the low side. So you will see in terms of our positioning as well at the Sanlam Investment Group, that view is then reflected. Okay, now related to this is that the dollar matters. So I know one of the questions I've got over the last couple of years on the Mauritian economy is constantly currency. Right, because we went through a patch there where the currency was persistently weak, obviously doing relatively better against the dollar over the last while, the last short while. But when the US raises interest rates, the dollar's strong. We've seen that so many times. Dollar strong, there's another thing that happens, of course, not necessarily that important in the case of Mauritius, but in the case of many countries on our continent, commodity prices are weaker. Why? Because commodities are priced in dollars. Dollar stronger, you need less dollars to buy the commodity, so the commodity prices are lower. Now, when the dollar is strong, it has a big impact on a number of countries. So Botswana, of course, managed PEG, or managed PEG, so that over time is a depreciation that they manage in terms of inflation differentials. They've got the reserve to do it, so not much big impact there. But we saw there Mauritius, in terms of the last while, we've had the depreciation of the currency consistent against the dollar. Same with the South African rand. Now, to some extent, one must remember when you're in an economy like Mauritius and you're beginning to become part of the global economy, you're integrating a lot more into global financial markets, that interest rate differentials over time will start to matter more. So maybe, can I make the argument that a little bit of that currency weakness was perhaps the interest rate differential, which we know is still a bit negative at the moment against the dollar. But we're going to get back to that because there are a lot of other developments that have helped the Mauritian rupee over the last while. But then look at that one at the top, Zambia. Look at that big depreciation. In a global environment of tightening global financial conditions, and you start looking at global bonds more carefully, and you start looking at fiscal policy more carefully, Zambia was one of those countries that stood out as being, unfortunately, not doing the right thing on the fiscal policy front, and that's been reflected obviously in its currency and eventually the debt default. The question is, will the dollar then remain strong? So it's been strong. So this is the dollar in real terms, adjusted for inflation against the weighted group of currencies. And yes, look there, it's been as strong as it's been in the early 2000s and the mid-1980s, so no question there. Does it weaken anytime soon? Does it get replaced as the world's reserve currency anytime soon? My answer to that is no, probably not in my lifetime. Because my age, you don't necessarily have that much lifetime left. But yeah, probably not in my lifetime. And the reason for that is twofold. Europe, in the background, I'm consistently always in the long term worried about disintegration risk. I'm not saying it's going to happen. It might be a low risk, but the risk is there. In terms of China, now China will increasingly, the renminbi will be used obviously in global markets and particularly also then for trade, but at the moment it hasn't got full convertibility on the capital account. So it's also not yet a candidate for reserve currency of the world, although it will become far more important, and over time we'll have to wait and see. But for now, the dollar holds a liquidity premium. It's about 58% of total allocated reserves, right? So yes, there's been a downward trend, but it's still the dominant currency that people want to hold. So for the dollar to weaken, what am I waiting for? Because I'm not going to show you the chart, but it's cheap, right? The dollar's, beg your pardon, expensive. Dollar's incredibly expensive at the moment. Anybody who's been to the US recently will be able to attest to that. Probably won't weaken though before the US starts to cut interest rates. And in the near term, we know that in Europe growth is going to be especially disappointing as well. So in terms of relative monetary policy, the dollar's probably going to hang in there for a while more before it does weaken, but still, as I say, probably remains the world's reserve currency. Right, so what have I got so far? I've got watch for the lagged impact of interest rate hikes in the US, potential for downward surprise on GDP growth in the US, perhaps then obviously globally as well. And obviously that has implications for one's equity positioning. At the same time though, let's not get too negative, because once the Fed does start cutting, then that should lead through to more conducive global financial conditions and a better outlook for emerging market economies. For the longer term, though, it is a more difficult environment to invest in. Now, there's a whole, obviously, you can spend, I suppose, a good couple of days talking about geopolitical risk, geoeconomic fragmentation, the implications of it, global warming, all of these things and the impact that they're going to have on the world economy. A couple of things, though, I think that we need to bear in mind. One is that global growth has held up this year relatively well compared to expectations at the beginning of the year, and that's because of the bounce in services. A lot of that was that revenge tourism thing that people had going on there. right? So that's going to fade, and already look at the PMI data, that is fading. Manufacturing has pretty much been weakish to flat all through the year already. So from a cyclical perspective, I'm worried about growth. Talked about the US and how that could work through. Then the thing that does concern me is and how to summarize all of this that's going on in the world. Now, I don't want to oversimplify things, but the bottom line of what's going on here, I said I'd talk about structural trends and themes. The bottom line of what's going on here is that we're going into a world where we used to have geo-economic integration, globalization. In my mind, that drove growth higher and inflation lower. It improved that trade-off. What's happening is the reverse. So if you look at trade restrictions, look at the number of trade restrictions around the world, how that's beginning to rocket upwards. Unfortunately, share of global trade share of trade in global GDP, that middle chart. Look how it ratcheted up there in the 1980s and 1990s, and then topped out in the mid-2000s. During that period was when inflation was being driven low, growth was starting to pick up, and you ended up with the Goldilocks era of good inflation, low inflation and good growth. That is beginning to fade. That's a very important development, reflection of what we have on the left. And then in terms of geoeconomic fragmentation, what we are beginning to see is global capital flows starting to reflect this. And so you're starting to see it in strategic investments. What is a strategic investment? For example, semiconductors, right? So that's the right-hand chart from the IMF. If you look at the flow of global foreign direct investment to global foreign direct investment destinations, strategic investment, how it's picked up into the US, and that's partly because of the policies that they're implementing, and how it's unfortunately declining into the emerging markets of Asia. And what the outcome of this is, ultimately, is a worsening trade-off between growth and inflation. Global trade topping out, this percentage of global GDP, this realignment of capital flows, you end up with lower growth than you would have had and higher inflation than you would have liked. Looking at the 5-year ahead global GDP growth projections at each point in time, and how that's, obviously that cut-off there should be US starts tariff war with China. It wasn't only that, it's been all these other things that we talked about. And you can see there how growth expectations have declined going forward. These are the growth outlooks for the next 5 years. It's not the world that we knew, and you've got to be far more nimble, and you've got to think through your asset allocation, obviously, very carefully in that environment. Okay, a couple of things. I said I'd look at how we look at growth how we look at fundamentals at Sanlam Investment Group. How do we know if an economy is going to grow fast or not in the long term? Okay, so unfortunately, because we haven't got much time, we're going to oversimplify this, but I'm going to try and at least go through the basic threads. Right. So this is relative per capita income. And we can see there the emerging economies that we've had in the world in recent years. So this is GDP per capita relative to the United States. Okay, just picking a country, developed country with a high GDP per capita and showing the growth relative to that. And that's what growth is over time. It's about catch-up, right? And you can see there that India and China are the countries that have been doing the upward trajectory. And look at Mauritius, how well that has been particularly doing as well. So obviously doing a lot of the right things. And GDP per capita, you think about it, what is it? It's productivity. What you produce per person, right? And then unfortunately, look what South Africa's been doing. We'll end up in a short while with what's going on there. But what drives growth? Again now, sorry, this is going to be an oversimplification, but there are two things. Employing more people productively. So labor force growth and then population growth and demographics is important. Young, growing populations have always got an advantage. And at the same time, are you being productive? A lot of stuff goes into that. But the bottom line is one of the most important things is human capital. And the Human Capital Index, this is from Penn World Tables. You can see there how that's moving upward in all those three economies. And look at it again, Mauritius doing particularly well on that front. And therefore, it's no surprise to see that on our continent, it is one of the standout economies that there is. But now, sometimes things go a little bit wrong. One of the big questions at the moment is when I talk about the global economy, I've talked a lot about the US and the Fed and the importance of that. And yes, US growth, it's still the world's largest economy. But China really is also where it's at for the global economy and for emerging markets, right? China's not going to keep growing, then we've got a problem. So I think China does keep growing. I just don't think it keeps growing as fast as what we were historically used to. It's probably got a potential growth rate now of about 4%. That might sound very disappointing compared to where we've been, but it's a very big economy. And if it's growing at 3 to 4%, that's still adding a lot to GDP. And incidentally, during the pandemic, it kept its position in terms of share of global trade as well. Right. But at the moment, there's an issue, and we've got to think through that issue. Bottom line is China the next Japan with its property market? For now, I think the answer is no. What I do worry about is when I see an economy with a very high level of capital stock to GDP. The capital stock is the sea green line. It's reading off the left-hand side of each chart, left-hand axis of each chart. And then the blue line is, blue line is capital to income, reading off the left-hand side. And then the sea green line is fixed investment as a percentage of GDP, reading off the right-hand axis. So when I see a high level of capital stocks, in other words, there's a lot of machinery and equipment and buildings relative to the size of GDP, plus still a very high investment ratio at the same time. So you've got this very high level of capital stock, but you're still investing. I always am concerned when that point comes, because your marginal productivity of capital starts to decline. Your efficiency starts to decline. It's very difficult to maintain productivity growth in that environment, and that's why China's economy is slowing. Okay, so case of India, Mauritius, those investment ratios are not that high, and also if you look at the capital stock, not nearly at that same level. So that means that if you implement the right policies, that your economy is going to keep growing at a fairly good pace. You've got that leeway and that leverage still. But unfortunately in China, so we can't, it's a whole thing to talk about China's property market. But why do I not think it's Japan? In other words, that we're going to go through this long sustained deleveraging that's really damaging and gives you very weak growth outcomes? The reason I say it is that for now, what China's managed to do is, in terms of its property market, you've seen the big hit in volumes. Not so much prices. Yes, prices are declining, but it wasn't in Japan. You had the big hit to volumes and to prices, and you had a proper balance sheet recession. Falling asset prices, forced asset sales, more falls in asset prices, and it becomes this very damaging feedback loop that results in a very damaging deleveraging. So the thing you've got to watch for in China is property prices. What you don't want to see is those property prices starting to fall. There are other reasons as well, is that long-term demand in cities could actually still be very good as people from rural areas still continue to move into urban areas. That's also another factor. Do worry, though, about the level of debt. So it's very difficult for China to keep stimulating the economy. And that's why I say lower potential growth rate than what we've known. Okay. Right. In terms of India, didn't mention much about that. Said if they implement the right policies, we're on the right track in terms of the cycle. Inflation moderation, interest rates are probably peaked, relatively good place to be. If the US comes through eventually with rate cuts as we think later next year, that's pretty good for the cycle, and we continue to see strong growth there. Right, so Mauritius. Said I've got a lot of questions around about the currency over the last couple of years and why it's been so weak. One of those could be, more recently, as I say, inflation differential, but of course it was about the pandemic. All right, so we know that a very important component of Mauritius's economy is tourism. It's not just tourism, but that is an important component, and it's an important component for the balance of payments. So left-hand chart, sustained fall in foreign exchange reserves. When I look at economies on our continent, it's the first thing I look for in terms of the outlook for the currency. What's the balance of payments doing? Where are the foreign exchange reserves going? When you have a sustained fall in foreign exchange reserves, says there's pressure on your balance of payments, says there's going to be pressure on the currency. That has now stabilized. Why is it stabilized? Look at the tourist arrivals and receipts. I'm sorry about the axes. Something seemed to have gone wrong when I converted into a PDF file, so hopefully it's not too irritating or too distracting. But those tourist arrivals I see in October, 125,000 people, probably on track. I think the estimates at one point, I think from your statistical office, would be 1.3 million for the year. Looks like we're on track for that. And look at the nice receipts. The receipts have actually rebounded in terms of rupees, more spending per person. Obviously, that's also a reflection of the weaker currency. And also on the right-hand chart there, you can see that sustained period of weakness that we've saw for so long seems to be topping out. I think that can last. One is just on a valuation basis. In my particular view, the Mauritian rupee is cheap. At the same time, if I look at the balance of payments, yes, wide current account deficit, we know. 6.7% of GDP second quarter, but more than halved from more than 15% deficit a year ago. Looking at capital flows, foreign direct investment inflows, other inflows, expected to have a positive year overall on the balance of payments. In other words, capital inflows exceeding the current account deficit, and that's what helping to stabilize the currency. Last year you had the opposite. That was putting the downward pressure on. Right. Other than that, what can I say about Mauritius? Gee, just nice to look at it, right? Growth of 6%, inflation 4.6% falling, unemployment rate 6.4%, fiscal policy, Standard & Poor's, kept you investment grade. Yeah, I think I'm going to move here. Okay, so just a couple of charts around fiscal policy, because that's where the focus is at the moment. Very boring topic, fiscal policy, right? But at the end of the day, you can go look at any economy. It's what fiscal and monetary policy do on a sustained basis over time that will set the tone. If there's a problem in an economy, it's going to show up in its fiscal policy. The pressure will show up there, and the unsustainability or sustainability of fiscal policy is a particularly important thing to look at. Right. Lots of charts here on a page, and I'm just glad to see that my axes finally work out. So I'm really going to linger on this slide and for quite a while. Okay. Yes, it's running a deficit, left-hand chart, whether it's the total deficit or the primary deficit. What's the primary deficit? The primary deficit is revenue less non-interest spending. And I'll show you in a second why that's important. The structural balance is better than the overall budget balance. What's the structural balance? That takes the budget deficit and then it adjusts for the cycle. So it says that, sometimes you're temporarily growing slower than what your potential is. That has an impact on revenue. Your deficit looks a bit worse. When you adjust for that, the deficit looks quite a bit better. And also you can see the fiscal consolidation on the government total expenditure side there after the pandemic, necessary spending coming through. So those are good indications. But this is the thing that I go to when I look for the sustainability of fiscal policy. When I look at any country on our continent or anywhere in the world, it's what is the level of the primary balance? Remember, we said revenue less non-interest spending is needed to stabilize the debt ratio. The debt ratio keeps going up over time with no sign of slowing, of stabilizing or coming down. That's an unsustainable fiscal position. I don't worry that much about the level of the debt. Although when you get above 80%, you've got to be very careful. But it's not so much about the level of the debt. It's can you stabilize that debt ratio? Bring it down. Now, that's where interest cost comes into perspective. If you're paying too much interest on your debt and you're growing too slowly, you're going to run into problems because you have to run a very, very tight fiscal policy in that instance to stabilize the debt ratio. Look at Mauritius, left-hand chart, interest cost as percentage of revenue, it's only just a bit above 10%. I'll show you an economy at the moment where it's above 20%. It's a very uncomfortable position to be in, but that's very comfortable still. Effective interest rates, around about 5% in nominal terms. And then the important thing, the real interest rate less the real GDP growth rate. If you're paying a low real interest rate on your debt and you've got a sustained high real GDP growth rate in the economy, it's much easier to stabilize the debt ratio. Why? Because you don't have to run such an onerous fiscal policy in terms of a primary budget surplus to stabilize it. So that comes to the right-hand chart. Now I know it looks very volatile, and unfortunately that's the impact of inflation during the pandemic and afterwards. So the spike in inflation naturally brings down the real interest rate, so it distorts the sum. But the bottom line is just look at the projections here. These are IMF projections over the medium term, 2025 to 2027, and it shows you that the real interest rate is still low enough relative to expected growth that you don't even really need to run a primary budget surplus to stabilize the debt ratio. In fact, the debt ratio, the primary budget deficit that's predicted is more than adequate to help start bringing that debt ratio down. So that's a comfortable position to be in, all right? Now this is a global economy. Things keep changing. You've got to keep staying ahead of the game. You've got to keep implementing the right policies. As far as I can see, Mauritius seems to be on the right track for that. Right, so now we're going to finish off with a couple of charts around an economy that's not working so well. And it's not working so well because of its fiscal policy and a range of other issues, but as I said, this is where it's reflected. Right. So when you think about the potential for long-term asset prices in South Africa, this is one of the most important things you need to consider. Right, that's our potential growth rate. I didn't draw this by hand, by the way. I didn't take this is a Hodrick-Prescott filter. I filtered out the noise around the long-term trend. This is South Africa's trend growth rate. Right, so we can see there in the mid-1990s to mid-2000s that sharp acceleration. What was that? How did we manage that? Why can't we do that again? What we did back then, we brought down the government debt ratio. We implemented an inflation targeting regime. That brought down the whole structure of interest rates. Why? Because interest rates will respond to a falling debt ratio and falling inflation. What does that do? Gave you the strongest investment boom in the private sector as percentage of GDP South Africa had ever seen, at least since I've got data to the 1940s. What did that do? It was the first time in decades that we actually created a lot of jobs. Not enough, but we had good solid jobs growth back then. At the same time, we brought down tariff barriers, opened the economy to the rest of the world. What did that do? Improve productivity. What does productivity do on the charts that we'd shown earlier? It grows economies faster. At the same time, we had China's investment boom, and that also obviously then fed through into high commodity prices. So that was the cherry on top that helped us out there. But we reversed all of that. Trade reform started to stagnate, although that is a global thing, not a South African thing. It's a global thing. Down leg, though, is the one common feature. There were two, actually. Global financial crisis, the aftermath of that. Obviously, the legislation that came with that in the bank sector obviously was also then an impact. But the big thing and the big change was government fiscal policy and the rise of a debt ratio consistently. I don't have any problem with the government spending money if it's going to do it efficiently and on capital stock that's going to lift the potential growth rate of the economy by putting the infrastructure in place. We did not do that. We consumed. And so what that did, and this is the thing about economics where there's a great debate, but through many decades that I've been in this industry, I stick with this one thing. If you crowd out the private sector, you're going to grow more slowly. There's only so much savings available. If the government is absorbing a lot of savings, if foreign investors are not prepared to give you additional savings, someone's got to save to feed the government spending. Who's the someone? The private sector. If the private sector is saving, it can't be investing and growing the economy. That's what's going on in South Africa. Right. I'm not going to go through all the details of the latest budget numbers, but just to come back to that interest rate argument of mine. You do not want to get into the point where you start asking the question as to whether or not you are in a debt trap. When that interest bill starts to work in the background, when you start to see interest rising as percentage of GDP, this was the economy I was talking about with an interest bill of more than 20% of revenue. More than 20% expected for this year of the revenue that we get into the state is going to be spent on the interest bill. So we held the line. This was a very good budget. The Treasury did a very good job in containing spending compared to previous projections, but look what happened. Couldn't spend more on functions, so that's education, health, all of those areas. It had to constrain there because it had to make way for the interest bill. So if we look at next year's projection that we had in February this year, we had 362 billion and 397 billion projected for the interest bill. That's gone up to 385 and 425 billion respectively. So we kept the expenditure ceiling the same, but we had to constrain the rest because we're going to make space for this high interest bill. So you're at the point, and obviously what that does is it results in this, sovereign debt ratings. So sovereign debt ratings, the up leg there, where the rating was improving constantly, was that period that I talked about when we grew the economy fast. The down leg is the period where we've just come from peaking out mid-2000s. And what does that do? And you can go look at the chart. Upward pressure on real interest rates, consistently. What does upward pressure on real interest rates do? Crimps investment. Why are real interest rates going upwards? Real interest rates are going upwards because you have to compensate investors more for the increased risk. Otherwise, they will not hold your debt. What's the problem with that? If they're not holding your debt, they're not funding the government, they're not funding that spending. And it's reflected here in our balance of payments. During that period when they grew the economy strongly, the financial account is net capital inflows into South Africa. That's what helped us to grow as well. We had global access to capital. Both government and the private sector locally could borrow and spend. And we did it very efficiently back then. But then as those debt ratings declined, investors demanding more to be able to invest in South Africa, look at the net finance. Yes, it was accentuated by the pandemic, has gone marginally positive now. But look at the long-term decline in net capital flows. What does that mean? If you don't get capital in, you can't run a big current account deficit. And we see that in Mauritius' case. The current account deficit in part reflects investment spending. Because the current account is savings minus investment. If you can invest and grow the economy, an emerging market will typically run a current account deficit. But it can't do it if it can't get funding to fund that deficit. And that's where we are at the moment. Okay. But apart from that, I still think that hopefully we are at the top of the cycle and that we have some respite in the period ahead that gives us a chance to recuperate and to put the right things in place, which I still believe will happen in South Africa over the medium term. So hopefully as the Fed's going to take a while before it starts doing this. It wants to make sure inflation is coming down. But hopefully when it does later next year, in South Africa's case, when inflation peaks, that's normally the top of the interest rate hiking cycle. If the Fed is peaked as well, that will also help us out and we'll all feel a lot better by the middle of next year and give us some breathing room to hopefully start putting the right policies in place to sort out our potential growth rate and to lift it. And I'm going to end off with this chart. So if you look at that environment, if I'm right, and if we do get the Fed cutting interest rates at some point next year, global financial conditions easing off, then much better space hopefully for emerging markets. And if that's the case, the rand is one currency that's looking particularly cheap right now. That's the last chart I'm going to show you. I was dilly-dallying about showing you a chart perhaps on the rand is actually trading where it should given the shocks that it's facing. I don't want to end up on a negative note. End up on the note where it says it's pretty cheap. And so hopefully over the next year it does work. Now when I say it's trading where it should, it's because of a few things. One was electricity load shedding. You can actually show empirically what the impact of that was because it lowers potential growth. Secondly, Fed, which we've spoken about. Thirdly, commodity prices, which have come off quite sharply this year. When commodity prices fall, the rand falls. When commodity prices rise, good support for the currency. So hopefully, if we do not get too sharp of a slowdown in the US, hopefully China does not go into balance sheet recession, which was my argument. Global growth holds up okay. Our terms of trade, commodity prices bottom out and do a little bit better, or at least stabilize. I do believe that electricity will look a lot better next year in South Africa's supply. I think that's going to happen. Fed starts cutting interest rates. Get those levers pulled, then over the medium term, the rand can look a lot better. Right, so I'm going to leave you with that positive note. I've taken enough time that there's not too much time for questions. And if they're hard questions, I'm going to give them to Mark, and I'll take the easy ones. Thank you very much.
So, after talking about currencies a lot here, what do you think of the gold price? Thinking of gold as an alternative to reserve that you mentioned, the reserve banks hold their dollars, which affects how their local currency performs against the dollar. And then the other thing is, if you're looking for a rand hedge or Russian rupee hedge, it is in both our cultures to hold some gold, especially in our businesses as an investment.
I'm not going to give you where I think the gold price is going because I don't know. It's historically gold has obviously been an asset that you look at. I'm going to come back to the word asset. An asset that you look at when things become very turbulent, when you have high inflation risk. Then that's a personal decision, and that is very often where people have gone to also at least store a portion of their wealth. I suppose in this environment, it's not just about gold, it's about diversifying your investment portfolio effectively. Now, so come back to gold as an asset. So for me personally, doesn't earn me income, doesn't earn me interest, does not earn me dividends. Okay, so my own personal preferences, I invest in assets that earn me dividends and income, and I try and diversify. And when I look at, for example, I didn't say what our asset allocation decisions are because I'm not a financial advisor, but the themes that I spoke about, one of the risks is, I kept on saying if the Fed cuts after a period of time. So we're all assuming that inflation starts to drift towards where the Fed would like, which is around 2%, right? But there is a risk with that labour market and with that loose fiscal policy. That's why I put that chart in there. I don't like it when governments run loose fiscal policies for too long because it can be inflationary. I said it and make the Fed's job harder. But if inflation remains more, there is a risk here that inflation remains more sticky than we would like. What we've done in our asset allocation decision from that is we are quite significantly overweight in South Africa and, for example, in the US, in inflation-linked bonds to cover that risk. So that's how we think about it. When we think about the global risks, all of these things that are happening at the moment, I said, worsening trade between growth and inflation. If inflation is a worry, yeah, people do in times of high stress and uncertainty and high inflation and volatile environments, they look towards gold. That's a personal preference. From our perspective, what we've done within our portfolios, because we don't hold gold in those portfolios, but we do look at the financial assets that can give us some protection against that, and inflation in bonds, for example, would be another example. So what I'm saying is look widely. I'm not going to predict the goals.
Thank you on that. Yes, sir. Okay.
Thank you for the wonderful presentation. You mentioned a lot about the Mauritius economy, where it seemed to me that you spoke about a lot of the good things happening. Yeah. Could you tell us a bit about things that may be working, which you maybe if you project in the near future? What do you think about what is it that we're not doing well? And also the second question was, there's a lot of pushback against China in the world for various reasons that we all know about. Do you think that that would impact the Chinese economy and in turn the world economy? Because China is a big player in the world. So on these 2 points, you can just...
In terms of Mauritius, if you look at any economy today, the point of where Mauritius has been, it is, in terms of GDP per capita, look at our continent, clearly one of the richest economies around. We're starting to get to the point where, because of population growth declining, it's a natural thing, and if you don't have young growing populations, it means that your future is dependent on productivity. So, and productivity is such a hard thing to measure or to tell an economy how you can go about. But quite clearly, if you look at the world today, and I have not seen this adjustment in a lot of economies yet, is that there is a whole new world developing out there. That whole new world is AI and anything related to tech. So it's one of the reasons that we are quite excited about India for long term, is because of the strong focus in that area of the economy. High-tech exports, services, digital startups. So that clearly is a focus on that type of thing. And then, when we talk, people often focus on what's hurting them in the near term. So it's not nice to see a currency fall, and there's been reasons why the Mauritian rupee has been weak, and we've discussed that. But one shouldn't be necessarily afraid to run a current account deficit if you're investing in the right areas, which lifts the productivity and the potential growth, because then you get the income to fund it. So I think it's just a focus on that, and I know that people's eyes glaze over, but people do not like fiscal consolidation. And they don't like it because they say, well, the government should be spending and helping people, which is absolutely correct. The problem is, we've seen this so many times, I've seen this in so many countries, that you have space to spend, and you spend that, but you're not spending it in the right areas. You're spending it on current expenditure and consumption rather than capital investment, which is what we did in South Africa. And eventually you get to the point where you cannot help people anymore because you're so constrained. The bottom line in the world today is, if you're not going to fund yourself, you're not going to be able to spend. So, very important to change the mix of spending heavily towards CapEx and areas that I just mentioned. But as far as Mauritius goes, you can see the fiscal consolidation path is there. I know it's a very unpopular thing to do. It is a very unpopular thing to do, but you've got to be clever about, and to the extent that you have space other than CapEx to spend, you've got to really target that in the right areas. So it's a question of skilling your people, because that's the best protection you can give. So I would leave it at that. But as I say, as I look at Mauritius, I love coming to Mauritius. Well, it's the first time I've been there. Like looking at it as an economy, which you can tick so many boxes so quickly compared to many others. So right path already, but just gear up in those areas that I mentioned.
Thank you. Any other questions?
Cool. So I think that China's got a lot of advantages. I talked about from a balance sheet recession, got a very large domestic market, still got a very strong manufacturing base, came through, even though we're trying to move towards more consumption spending. Not quite managing that at the moment. It's quite important that it continues to make that shift, because China's got such a high level of investment, it's a very credit-driven economy. And that's why it's sitting with such a high debt level that you can't continue along that road. So what I'm looking for is a shift towards consumption, but it is an economy that in certain areas is moving into high tech. If you look at new energy and you look at sustainable vehicle production, it's a leader there. And so the tech war with the US is very damaging for everybody. Nobody wins. So that's a setback, but you can see China moving in particular areas where it is looking at that innovation and tech-driven type of growth. So I don't think that economy, watch the housing market, it is important, it's critical. I don't think it collapses into a very low growth scenario. I think that it's got a good potential growth rate of close to 4%. And that's a big economy. It's growing at 4%, that's adding a lot. It's natural for an emerging market to get to that point. It's not going to keep growing 10% forever. And we've seen the long-term decline in the trend growth rate. For those reasons, I think that it can at least sustain that kind of potential.
Thank you. I'm Doyle from Sanlam. I've got one question. I was listening last week to one of your colleagues. His name is Dave Lurie, and he was talking about expected returns in the next future years, US stock market compared to South Africa. And basically what he was saying is that he's expecting returns from the US market to be quite flat over the next few years, as opposed to quite interesting returns from the South African stock market. Do you share his view?
Yes, so we think the US market is expensive. So if you look at our asset allocation and our balanced funds will be underweight and have been for a long time US equity. And yes, we are overweight South African equity, so we share this similar view to that. Now we've got, in terms of our asset allocation for our balanced funds, it's important to mention that it can vary between funds. But we're overweight South African equity, and we are overweight South African inflation-linked bonds, and we are neutral weight on conventional bonds, nominal bonds, underweight cash to balance that out. That's South Africa. And then in the US, we are overweight inflation-linked bonds, market weight conventional bonds or treasuries, and then underweight equity.
Okay, to sponsor South African areas been in, they are adding new funds to Kigali and Abidjan, so they must be concerned about the gold prices. Talking about China possibly slowing the economy, there seems to be depressing gold prices, all the geopolitical tensions affecting gold prices. What do we think about how that could affect our forecast?
So I go with our analysts. Our analysts have got in the region of, I think, about $90 over the medium term, so not much change because of what we do is look at production cost, and so it's a different calculation, but also it would, if you think about it, fit the worries that you have. There's downsides applied in global growth, then that's obviously downside, and then unfortunately if you look at the Middle East, if there's escalation, if there's escalation already, then it's about unfortunately, big forces working both directions. But the calculations we do, which is more based on production cost, is about $90 medium term. So actually balancing the two arms.
And say since World War II, how would you rate current geopolitical tensions?
Okay, let's say something that sounds completely offbeat compared to because the geopolitical tensions that we have are serious and are obviously having an impact. But it's low. Right? So that's a very important point. Is if you look at geopolitical risk, if you look at the different ways of measuring it, a lot of people look at newspaper headlines and how many times the thing is mentioned, and you go to the World War, because these huge spikes. And since the World War, the two World Wars, you had a lot of spikes in between. That it wasn't insignificant, not as big as that. And when the war broke out between Russia and Ukraine, we had a similar spike again to like you had the Vietnam War and the Korean War, and it's come straight back down. It's going up again now, obviously, but compared to long-term history, no. So the valuable point here is that markets have dealt with this for many years, decades and decades. It's not something new, and in the context of that, it's actually not an unusual time. And that's why when we look at some, so when we talk about our asset allocation, we go overweight, underweight, given required returns that we need from that before we decide to invest in something. Where do those required returns come from? We look at long-term history, and that history goes back 100 years because it covers the world wars, the Great Depression, the global financial crisis, all of these geopolitical tensions and events. That's why we take such a long-term view. And that is why we've been sitting underweight US equities for so long, but we're sitting there and we're not going to move from there. Okay, so that's an important part of that.
You don't need to worry about World War II.
No, well, I'm a political analyst, but it's not something that's top of my mind.
I'm Catherine. I've stayed in South Africa for 10 years. Back, but I'm glad that as a chamber and I feel in South Africa, a little Joburg here as well. Most welcome to join us one day. What I wanted to say is that I've been looking about the free zones that China has been putting in continental Africa, and I was asking what are they after, knowing that they are technology and innovation driven. It's an economy which is going that way, and for example, Hainan Island is going to exceed Sanlam in technology. And so I'm asking myself, and I see, and I was asking Ben, what about the rare earth? I know that they're very important for superconductors and semiconductors, and I read there that China has them all. But I do know there are other sources, like Eswatini, we have very much rare earth there, even Madagascar. And maybe using the Pareto rule, maybe doing that 20% would somewhat give us that 80% we need to boost up the economy. And also maybe the AFC, FTA, the market agreement in Africa. And we ourselves, Mauritius, we have been doing many free trade agreements with many countries, targeting 70% of the world population. And this, some clever, smart choices we've been doing during COVID, thinking very strongly about as well from getting off the grace into the report time of 23 months. So I'm asking, maybe our way is to think out of the box and also looking at the Southeast Asia. We've been looking at China, we've been looking at the world's biggest economy, but Southeast Asia has got much potential. I mean, we've been going there, we asked Bilal as well to follow us there. For example, Indonesia is becoming the 5th economy. It came up from 7th, 5th economy. And there will be much spillover because it's moving its capital towards Malaysia. So much, I was talking to you guys about Starbucks. So it's welcoming people for the silver economy to come there, and it was 200,000 rupees, 20,000 ringgit. You go there, you put it in the bank account, and you remove the half of it the next year, and this is it. You're going to stay in the country. Maybe you get land to develop because all the resources, just a sharing. So because I'm merged to South Africa and I would like them to be very much in a better position. And maybe we can do a 35% product transformation in Mauritius and make all these bilateral trades with USA, UK, continental Africa, Turkey and China and India. We can use that, and we know how to do that 35% transformation in bonded warehouses. And maybe that would be a little ease that can help everyone. Thank you.
Thank you very much. Well, those are critical points, because presentations we give. The African Continental Free Trade Agreement is probably underestimated in its importance and what it can actually achieve on this continent of ours. And I fully agree. And so it's also clear to me that when people ask China and Africa and the relationship, it's very clear that China can recognize Africa as the growth potential. So there's also that angle of facilitating development in Africa, which the positives of course come back as well. You mentioned Gregor said it's very difficult because every time I think I'm on top of something when it comes to environment, and this is the thing about economics today, is the thing I must realize is that it's not a single disciplinary science anymore, it's multidisciplinary. When you look at global financial markets and economics and strategy, you actually need teams. One example is lithium batteries. So suddenly now we talk about sodium batteries. So I was like, anyone with lithium, that's a great place to be. Suddenly now you've got sodium. And so it isn't it? But bottom line, if you look at an electric vehicle battery, the reason I know this is from Portugal is hydrogen. So more than 70 kilogram of that battery is metals and minerals. People don't realize that. So it's not a question of just when Africa's developed African continental free trade agreements, but some of the older industries can also still do particularly be smart. Okay, I ran for an tangent, but I like those points. I think they're very important points to raise, because we see this continued move towards deglobalization, but yet there are pockets in the world where you have possible. And very positive.
And there's also the hydrogen.
Exactly. Yeah. See, this is the one thing that also, as a final comment, will make a very big difference. So when I talk about deglobalization having worsened the trade between growth and inflation, technology can help bring it back the other way if you implement it efficiently and with some force. Thank you very much. Those are critical ones.
So thank you very much. Thank you, Arthur. Well done. Thank you very much. Thank you for organizing Asia disappeared. Guys, the ladies, thank you, Asia. The night before, it was very late, making sure everything is set up for us in the morning, so really appreciate all of that, guys. I'm preaching to the choir a bit here, but we just trying to make sure we can get hold of all of our members. So if you are here, we managed to get hold of you. But we are hearing that some of the members are not getting the emails. So we discovered there's a firewall issue where some companies' servers are blocking our emails because they think it's spam. So if you can just pass that word around, that if you are a member of the channel, you're not hearing from us, he's going to start checking your spam folders. Kim is trying to contact people one by one to ensure that the company's firewalls hear us in. And if you can also just let them know that we are posting every bit of information on Facebook and LinkedIn as well. So you've got 3 places to really get all the information around what's happening in the chamber. So our next event will be in January 2024. So guys, that's a wrap for 2023. Thank you everyone for your support for 2023, and we hope you have had a great year, and wish you all the best to your families over the festive period.